So, Bill, you said that you expect the Federal Reserve at some point later this year to kind of end its long stay at 0% interest rates, raise rates. There's been some discussion and maybe confusion about some of the signals coming out of the Fed. What makes you think that at last we might be at that point?
And there's been some confusion, Mike, for about 4 or 5 years.
That's right.
In terms of language and the transition of language. I just have a sense, based on some of the Fed statements, Janet Yellen and others, that they want to get off the zero line, if only as a signal to suggest that rates are normalizing, that we know that the U.S. economy is doing better than most, or perhaps better than any developed country. And I think the Fed recognizes now that capitalism, the financial system, has been distorted to some way of thinking, that the money that they created through quantitative easing and otherwise, has gone primarily to financial assets as opposed to the real economy, and so I think the real economy being their ultimate objective, that they want to raise rates by a little, not by a lot, because caution is the watchword and has been for 5 or 6 years in terms of monetary policy, but they want to move it a little, and the date in terms of when that happens, June has always been the month that most of them circle around, and so maybe June or July, but a small increase, and probably one only for the year would be my guesstimate.
So this signal then, I guess, if it means that they've recognized there's been some distortion to the financial system by staying here so long at zero, what does that kind of mean for the way the system might react and adapt to that? I mean, even if it is just a token change, it seems as if there's a generation of investors almost that really doesn't know how the markets are going to metabolize that change.
Well, they don't, and they didn't in 2006 and 2007, which was the problem, as I see it, when the Fed raised interest rates to 5.25% way back when, probably in 2005, as I recall. There was not a sense that that interest rate could in any way be onerous for the economy and for the housing market, but in fact it was. It was a high real interest rate, a high real short-term rate, and in a levered economy, as it turns out, that rate was simply too high for borrowers, for mortgage borrowers on housing that were dependent on variable interest rates and couldn't cover the payment as interest rates rose. So, there's been a transition since in terms of thinking. I'm not sure that the Fed is gone off of their modeling of the past 20 or 30 years, but I think in some circles there's been a transition to acknowledge that there is what I call a new natural, or others call a new neutral interest rate that is substantially below what used to be. What used to be was what they call the Taylor rule. John Taylor of Stanford in the late 80s, he established a norm of 2% real in terms of the Fed rate and 2% inflation. In other words, a normal 4% rate. Since then, and because of the leverage and other structural headwinds that Larry Summers has spoken to and that I agree with, it's clear that the 4% rate would probably do what the 5.25% rate did in 2006 and 7. In other words, precipitate a new recession. And so there's a lot of uncertainty.
Yeah.
And no one knows in the market what that perfect rate is, not too hot, not too cold. And so the Fed, like all central banks, will proceed cautiously.
Yeah, and the argument, of course, for proceeding very cautiously, and in fact, maybe, as some would argue, really obviates the need to move rates at all, which obviously is, inflation rates still falling, obviously lots of fragile economies around the world, and all the rest of it. In other words, a lot of people out there saying, what's the rush if it could be a rush when you've had rates at zero for this long?
Right. Well, I think the need, and there is no rush, and there hasn't been a rush for 5 years, and I've agreed with that policy. Ultimately, though, there needs to be a normalization to some extent of interest rates. Savers, small savers, large savers, desire, they can't always get, but they desire a return on their money in real terms. And so now that when they go to the bank, they earn close to nothing, and now in the short-term markets where they earn close to nothing institutionally, and of course, for example, now in Germany and Switzerland and other countries where they pay in terms of negative interest rates for the privilege, at some point, in order to invigorate savings and importantly investment, it's one thing if the savings receives a higher interest rate and just sort of sits there. In other words, banks don't lend. It's another thing for the real economy, for real investors, for companies, for corporations, for innovators, to take advantage of a higher return on investment and a higher return on equity, which would come from the gradual raising of interest rates. They all move together. And that's really been the problem over the past 4 or 5 years, why the U.S., even the best of countries in terms of growth, has only grown at a 2% or less real growth rate, is that investment has been stalled and stunted based upon these low interest rates. Why would a company, for instance, if they could only return 4 to 5% in terms of their investment, why would they take the chance on a 30-year project? It's the same example, common example to me as to why would somebody on my side of the table, in terms of an investment company, why would you buy a long-term treasury bond at 1%? Not at 1%, but you get my example. When, in fact, a 5 basis point change in that yield could wipe out your capital. It's the same thing with the real economy. If returns are too low, then the large projects, the large investments don't get done because there's too little return for the risk.
It would seem, though, that so if we do get some kind of a small, kind of modest change in the very short-term interest rates, I mean, do you really think that would have an impact of changing the yields on other instruments very dramatically, or would it just be the beginning of a very long process for that to happen?
I think the latter.
Yeah.
And I am not suggesting that the Fed immediately moved to the new normal or the new neutral type of interest rate. Right now, the market, in terms of the forward curve, anticipates that the Fed won't get to 2% until 2019. That's 4 years away. And I think that's a pretty accurate assessment if the U.S. can demonstrate continued growth over that period of time. So, I'm not suggesting anything quick or substantial in the short term, and I'm sure the Fed knows that they don't want to rock the boat either.
Yeah.
1937, the Fed made a mistake. They raised interest rates, and some blamed that for the continuing depression until World War II. So, they'll be very cautious.
And in that scenario, if they are very cautious and slow about changing things, you've said that you feel as if equity markets, say, might be reasonably well supported because that will be such a gradual process. Do you think in general the markets are in a position where they can kind of handle this shift, even if it's mostly a psychological one?
In terms of the current prices, yes, but dependent upon several conditions. One, stocks depend upon future growth. If earnings never grew, then their multiples would be a lot lower. Sure. As opposed to where they are. So there has to be some 2% plus or minus real growth over the ensuing period in order to justify those PE multiples. And I think that's the probability. But there's risk. There's risk from the standpoint of the global economy. The Fed spoke to that yesterday. For one of the first times in a long time, they said that international conditions were a factor in terms of their future thinking, which meant if Euroland and Japan and other developed countries didn't dig themselves out of the hole, then it would ultimately, affect the United States, and it does, because secondly, the dollar, although up until this administration, or at least the 6 years plus of this administration, that a strong dollar policy hasn't basically been advanced or emphasized, but it was prior. All you ever heard prior to that was the strong dollar is good, and it is in many ways. But a strong dollar, in terms of a 15% appreciation over the past 6 to 12 months relative to most countries, puts the U.S. at a disadvantage in terms of exports, and obviously affects earnings for global companies. So the Fed has to observe growth in other countries. That they have to perhaps carefully look at China in terms of whether they can continue to do 7%, and that growth outside the United States as well as inside the United States becomes an important factor. So I think stocks can be supported. I don't think that they can do what they've done in 2014 and prior periods since the Great Recession, since quantitative easing, where investors sort of expected 10, 15, 20% on their money. Those days are gone. And like I said in my investment outlook this month, speaking to a monopoly board, if you're familiar.
Absolutely.
They're
Monopoly game board, you mean?
Yes. I mean, there are certain attractive properties, not Mediterranean Avenue, and not surprisingly the Park Place or the Boardwalk, but the oranges and the reds are the most attractive from a risk and return standpoint. And so I think the equity market, and indeed all markets, have been in the oranges and the reds for 20 or 30 years, but now they're going to be forced to accept the railroads, the utility, electric utility, and perhaps some of the greens and some of the blues, which means lower returns.
Yes, lower expectations would probably help in that regard. It seems like if you were an owner of riskier assets for this past 5-year period, you had, in some sense, an idea that it was heads I win, tails you lose, in the sense that if growth is good, I'm benefited. If growth kind of disappoints a little bit, we are confident that we have central banks, mostly the Fed, to help us out. So I wonder if this sort of hesitancy that we've seen so far this year in some of those markets is a matter of maybe that calculation is changing a little bit. In other words, if we're hoping for a more accommodative Fed, we're kind of hoping for truly bad things, and if we get decent news, then the Fed's going to be less friendly.
Yes, and as you described in the past 5 or 6 years, the Bernanke put, the Yellen put, now the Draghi put, whatever it takes. Central bankers have been able to not only convince the investment public, but to put it into effect through quantitative easing. In the United States, $4 trillion worth of expansion in terms of the Fed's balance sheet, not so much in Euroland, but big time in Japan. So central bankers basically have been validating the whatever it takes. The problem is at this point, with interest rates at the zero bound, and with German interest rates and Switzerland, as I mentioned, negative, it's hard to lower interest rates much more. And the effect of future quantitative easing, which in its infancy lowered interest rates, in other words, the effectiveness or the value of the put, of the Bernanke put, the Yellen put, is called into question. And so yes, unless there's real growth, I think investors will look around like Wile E. Coyote, you know, as he runs over the cliff, and looks down, and then you know, not straight down,
Sure.
but you get the point.
Yeah.
So, and that's the essence of your question. I
Yeah,
think
absolutely.
That's true.
You mentioned the dramatic move in the U.S. dollar gaining against just about every other currency. It's just one of the real kind of extreme recent asset market moves we've seen, right? You have the oil crash, somewhat related, I'm sure. And obviously, you know, just that suppression of bond yields took this extra leg down around the world too in developed markets. Is anything unify these things? I mean, is there kind of this volatility wave just being kind of circulating through all the markets?
Yeah, the volatility does circulate until, as you wonder, when there's stability and balance, and what brings that balance back, because there obviously was an imbalance in terms of oil and the supply that was being created, much of it here in the United States. There was an imbalance in terms of interest rates and currencies, and an imbalance in terms of trade surpluses and trade deficits. So it's a very imbalanced global economy, and the hope is that without excessive volatility, that sort of moves to the center as opposed to the wings, and I think it is. But all of that is really, to my way of thinking, a function of high debt and prior credit creation on the part of not just central bankers, but the private system. We overdid it. We brought consumption forward globally. That's what lower interest rates do, and that's what higher price earnings ratios do. And so the rebalancing almost necessarily depends upon the private sector having faith and confidence and hope in the future of credit and credit creation, that it does what it's supposed to do, that is oil the real economy engine. To this point, not so great, but the rebalancing essentially depends upon that, or else. You know, countries like Greece, perhaps, and other countries in their desperation simply say enough's enough.
And do you think, I mean, just to bring it a little bit toward Europe specifically and what the ECB is trying to get done over there, you know, you mentioned interest rates are already so low, it's kind of hard to know if that lever, you know, really is going to be effective at all to do QE there. But how does that filter into to the investors' thinking right now?
Well, I think it does. You know, investors know by experience of the past 5 years that a quantitative easing program helps with financial assets and to a limited extent in terms of real economic growth, or at least preventing you know, a decline in economic growth, all of the Great Recession. So an announcement of Draghi's program in March and the continuation in Japan, which are the two big centers now in terms of quantitative easing, that you know, investors sort of know that depreciates the currency, that makes you know, their stocks attractive, because that's what you know, the trek towards inflation does. And so financial markets are supported. Again, the ultimate question is, can they produce real growth? Can the private sector take the bait with interest rates at 0% and return on investment you know, in the 3s and 4s on a long-term project? And that ultimately is the biggest question, and one that is described by the old phrase of a liquidity trap. Investors know of the concept in general. It's hard to understand why liquidity, trillions and trillions of new dollars or yen or euros could be trapped and not circulate out into the private sector. It's because in some cases the private sector doesn't want to take advantage of those low rates, because the the investment return is not acceptable.
So then that's really the thing that's going to determine whether we escape this threat of deflation, I guess, right?
I think so, and that begs additional questions that Larry Summers, for instance, has accentuated in the last several months. Structural problems. Capitalism may have a structural problem in terms of demographics, for instance. We see it in Japan. We see it in some Euroland countries, and even the U.S. has its boomers, although it's in better shape. But the demographics of the developed world are such that an aging population doesn't want as many things as a younger population. No babies, no new houses, no new car or baby seat to fill it up. And so, capitalism faces that demographic problem. Developed countries face a problem in terms of already created debt, high debt to GDP ratios, which make lenders cautious. And interestingly enough, you mentioned you were in Silicon Valley. Technology displaces workers. It's wonderful that Google and Apple and other companies can create these magnificent technologies, but it is true that Apple doesn't create as many jobs as General Motors did in the 1930s and 40s, and so finding new jobs for these displaced people is a challenge that we have in the United States and everywhere. So these structural headwinds, present a problem for monetary policy and even fiscal policy that Keynes, for instance, when he came up with his idea of pump priming and deficit spending, that even economists from that era would be challenged with in terms of how to solve it.
Just to get it to a little bit on investment strategy and tactics, you've found yourself recently with a fresh pool of capital, right? So in other words, you can survey pretty much the whole landscape and in fixed income and such, and decide where there's opportunities or not.
Right.
Was it a very picked over market if you're looking at the monopoly board? I mean, are there pockets of opportunities that you see more than others, or is it just kind of lower your expectations and see what you can find sort of on a relative basis?
Well, I think to some extent, we see that with interest rates, with a 30-year bond at 235 and a 10-year at 170, it's 75, and with German interest rates close to zero. I mean, that is what you're going to get over the next 10 or 30 years. There's no real way over the term of the bond to produce anything more than that.
Yeah.
And so that speaks to bonds, and it ultimately speaks to stocks and certain risk assets as well. But the opportunity now, and it comes up from your prior question in terms of the imbalances, obviously in retrospect, 6 months ago, if an investor had been able to anticipate the strength of the dollar, the shorting of the yen and the euro and other currencies against it would be an opportunity. Yeah. And similarly, in terms of financial markets, as they move quickly, opportunities are presented that can be taken advantage of, and to increase what we call the alpha, or the outperformance relative to those 175% yielding treasuries. So it's not hopeless, but it certainly produces a lower expectation relative to the past.
Mm-hmm. And are there areas, I mean, one thing we haven't talked about at all really is the emerging economies and what's happening in their markets. Obviously, they haven't been able to kind of, pick up the slack in terms of global growth. Recently, we've realized, I guess, they're a little more, credit and commodity dependent than many thought. Now that they've underperformed for this long, I mean, are there areas there that seem to make sense, or, are the risks still, too upfront?
Well, I think there are some areas, and you know, as you know, there are emerging countries and ones that have sort of popped their head up above the water. You know, I've favored for a long time Mexico. It's attached to the United States. It's not, you know, totally a U.S. Enclave, so to speak, but the growth in the United States affects Mexico, and Mexico as an emerging market country has half the debt that the United States has in terms of sovereign debt. And of course, based upon the depreciation of the peso in the past 6 to 12 months, their exports are even more attractive, not just to us, but to China and elsewhere. And so, yeah, there are pockets of emerging markets that are attractive. There are others, as you suggest, in terms of commodity-based and having received inflows of investment and now being on the other side of the ticket that you know, have to be approached with caution because unless the developed world can really solve their problems, you know, the problems of the emerging markets continue because emerging markets are dependent upon the developed world in terms of demand. So they are linked, and because emerging markets sort of are on the periphery of wealth and credit, you know, they depend upon the center to buy their goods and buy their commodities, and as you mentioned, in the last 6 to 12 months, it hasn't really happened.
Yeah, exactly. And just finally, to get a little more toward expectations for a bond investor right now, you sort of said, you know, 10-year Treasury at 1.75 or something like that. You're kind of, that's about what you'll get over the span of the bond. Will you get that for sure? I mean, I guess that's the big question. I mean, are we anchored in terms of the value there to some degree, or might we see some kind of you know, greater risk of principal loss? Will rates shoot higher?
Well, yes, you are for a treasury. You're guaranteed that, but that's
Yeah.
at the end of the 10 years.
At the end, yes.
So what happens over the next year or two? You know, can bond prices go down? They can, you know, I experienced that early in my career in 79, 80, and 81 when interest rates on long-term treasuries went to 15%. So yes, you know, one has to be careful when you're making a longer-term commitment and interest rates are so low. So that's the caution, and you know, will that happen? You know, there's a possibility if Euroland is receptive to quantitative easing and begins to grow. If the United States stays at a 2 to 3% growth rate, and if inflation in the U.S. and elsewhere moves back up closer to that 2% magic level that the Fed and other central banks seem to want, then a bondholder would or should be very cautious. And so it's growth dependent and central bank response dependent. To my way of thinking, to answer your question in the short term, bond investors are safe for 6 to 12 months, but not for 10 to 30 years.
Right. That's fair.